following question is dealing with interest on a loan, and in this example we're going to assume interest is not capitalized, and then we're going to look at maybe in a different video how it looks if interest is capitalized. Here's our information. On the 1st of April 2013, XYZ Limited borrowed 100,000 Rand from ABC Bank at an interest rate of 10% per annum. Calculate the interest charge for the first year of the loan and show the effect on the journals, the ledger, and the balance sheet for the year that ended on 31 December 2013. Good, so let's start off. Let's quickly draw a timeline for ourselves. We'll see that the financial year for this company XYZ runs from the 1st of January 2013 to the 31st of December 2013, and we obtained this loan from XYZ on the 1st of April 2013. So let's go and put in our date. So January, February, March, April, that's 3 months down the line. This is where we received the loan, and the amount of the loan was 100,000 Rand. Good. So now what we need to do is to calculate the interest that was incurred for the financial year that ended on 31 December. So the cost of borrowing for XYZ will be from the 1st of April all the way up until the 31st of December, which, if you had to count them, would be April, May, June, July, August, September, October, November, December. That's 1, 2, 3, 4, 5, 6, 7, 8, 9 months. You could have done that in your head probably, but nevertheless. So if we take 100,000 Rand and we multiply that by the interest rate, which is given at 10% per annum, there we go, these are 10% per annum. So we take 100,000 Rand, we multiply that by 10%, that is equal to 100,000 multiplied by 10 over 100. That is going to give us 10,000. You can probably do that in your head. 10,000 Rand, which is the interest for how many months? This 10,000 Rand would be the interest for a full 12 months. However, in our example, we only have the loan for 9 months. So to get from 12 months to 9 months, what we need to do is to calculate the interest for 1 month, which we can do by saying 10,000 Rand times 1 over 12, and then after we've got the interest for 1 month, we can simply multiply by 9 months to get the interest for 9 months. Take a shortcut, we can simply say 10,000 Rand times 9 over 12. Again, the same principle. Take what you need over what you have. And that is going to give us 7,500 Rand interest. Good. So the interest on the loan for the full year thus comes to 10,000 Rand, and if we had to calculate for the 9 months that we had this loan, we got our final answer of 7,500. So now let's quickly go and do the journals. Well, we received 100,000 Rand on the 1st of April, so let's fill that in our cash receipts journal because this was money received. We received this money in April 2013. There we go, XYZ Limited. Document, we're not given that, so we can just fill in the generic number. Our day is the 1st of April. So we can put in the 1st of April. Our details is going to be ABC Bank, which is the bank from which we received this loan. And then we can fill in the amount in our bank column. And there's going to be no column for the loan, so we're going to fill that in the sundry column. And we're going to refer to our loan account. Good, the bank account will be an asset and the loan account is going to be a liability. Then that is the first part of this transaction, which was the receipt of the 100,000 Rand from ABC Bank. The second part is, or rather a separate transaction, is the recording of the interest. So this is the receipt of the cash. Now we need to record the interest at 10% per annum. So that we're going to do in our general journal. So we go to our general journal. Our document number is not given, so we can put journal voucher. The interest will be calculated at the year end on 31 December. So we can write 31 as our day. And then we need to determine our debits and our credits. So what has happened here? We've been charged for the cost of borrowing money from the bank. Now that charge we call interest. And since we've used the financing service, we have incurred an expense. Now our expense increased, and we know from debt click if an expense increases, that is going to be a debit. So that's the one part of the transaction, the interest expense. The other leg is the fact that we now owe a little bit more money to the bank for this interest that we have not yet paid. So the account that we're going to open up is called expenses payable. Now this is because we are not capitalizing the interest in this example. So expenses payable is a liability, and the liability increased. So we know from debt click, if a liability increases, that is a credit. So now we can go back and do our general journal, which will be a debit to interest on loan, and it will be a credit to expenses payable. Let's put in our debit here, our debit to interest on loan. Interest on loan is going to be an expense, so we can color that red, and we're going to credit our liability, which is called expenses payable. And the amount that we are debiting and crediting is 7,500, which was for the 9 months that we had this loan. Good. So that's our general journal. And finally, just to show the effect of this in the ledger, number one, the receiving of the 100,000 Rand, that will affect our bank account, which I'm not sure whether we have here. Sorry about that. We don't have the bank account here, but there you go. I have added the bank account, so we can now record the transaction. The bank account increased by 100,000 Rand. The contra account is going to be, remember you can never have a description that is the same. So the contra account is going to refer to my loan account. Then I'm going to go to the loan account, and on the credit side, I'm going to record the 100,000 Rand, and I'm going to refer back to my bank account. So in here, I'm going to write bank account, and my journal reference is going to be the CRJ, same year, this is going to be the CRJ 1, and this also happened on the 1st of April. Good, so my bank account is an asset, therefore it increases on the debit side and it decreases on the credit side. The loan account is the other account that is credited. So I go to my loan account and I've got the credit there of 100,000 Rand. I can refer back to the bank account, which was debited. That was the first transaction. Then the second transaction is the charging of the interest, which we need to record in our books. So we've got an expense that increased. So expenses increase on the debit side. So there we go. Let's put our interest, or let's just first create this account here. Interest on loan is going to be an expense. And my expense increased by 7,500 Rand. And the other side of this entry, you will remember, was the expense payable that we had to credit was 7,500 Rand. There we go. We record our expense payable account, 7,500 Rand against expense payable. And then it's simply a matter of filling in the contra accounts. So in here, we're going to refer to the expense, and in here, we're going to refer back to our liability. And this happened on 31 December, the last day of the financial year. We calculated the interest that we owe to the bank. In the general journal and in the general journal back there. So that is my general ledger. If I have to show the effect on the balance sheet, it will look something like this. The first transaction, the receiving of the 100,000 Rand, is going to increase my cash. So there we go. We can say plus 100,000 Rand in cash. And the other side was the loan account that also increased, plus 100,000 Rand there. Then the second part, the interest of 7,500. Remember what we said. If we have an expense that increased, right, what's going to happen to my retained income? My retained income is going to decrease. Right, so expense that increase causes retained income to decrease. So here we go. My retained income decreases by minus 7,500 Rand. And the other side of that entry was the expense payable that increased, which is going to be part of my liabilities. It's going to be a current liability, and more specifically trade and other payables that also increased by 7,500 because I now owe more money to the bank. And there we go, my total assets is equal to my total equities and liabilities. So how does this change if we say that interest is now capitalized, as is the case with most mortgage bonds taken out at banks? What that means is the interest charge that is levied to the borrower is actually going to be added to the capital amount. So if I have a capital amount of 100,000 Rand and, for example, 10,000 Rand interest was incurred, that means the 10,000 is going to be added to the 100,000 Rand, and it will effectively be capitalized, and the total amount will then be, sorry, not 100, 110,000 Rand that is sitting in the loan. Let's have a look how my debits and credits change. I still have the interest expense that increased, so the debit leg is not going to change at all. However, the credit leg is going to change slightly in the sense that I'm now no longer going to credit expenses payable, but I'm going to take the credit directly to the loan account so that it can be added to the principal of 100,000 Rand. So let's do that. My credit is now going to go to the loan account. So let's show this on our general journal. So remember, now we are assuming that interest is in fact going to be capitalized. So let's change our question. There we go. So the question now reads, assume that interest is capitalized. The effect of this is my cash receipts journal doesn't change because that only dealt with the receipt of the 100,000 Rand. My general journal, however, is going to change. The debit leg stays exactly the same. It's only the credit leg that changes from expense payable to loan. And then also my ledger, instead of crediting the 7,500 to the expense payable, I'm now going to credit that to the loan account. So we cross out the expenses payable credit and we take that to the loan account. So we put 7,500 on the loan account. There we go, there's my 7,500 from the general journal, and the contra account is going to be interest on loan, which is an expense, and this happens on the 31st of December 2013. Right, so my debit leg is on the interest on loan account, And the only thing that needs to change here is I'm no longer referring to expenses payable, but I'm going to refer to the loan account. Good. Lastly, the effect on the balance sheet. Let's have a look here. Everything stays the same. The 100,000 we received, the 100,000 that we owe, the 7,500 that reduces my profit and my retained income. The only change is that my expenses payable didn't increase, so we can take out the expenses payable increase, and my loan now is going to increase with the interest. And you can see what effectively has happened here is that the interest has been added to the original capital amount of 100,000 Rand, so that my total loan amount is now 107,500 Rand, and the interest we can say has been effectively capitalized. So the original capital amount was 100,000 Rand, and then we added our interest of 7,500, giving us a new loan amount of 107,500, and the interest has been then effectively capitalized.